Hey everyone, welcome in to another daily editorial here on the KE Report, a special daily video editorial as I am getting an update from Skeena Resources, traded on the TSX under the symbol SKE, also on the NYSE under the symbol SKE. I am chatting with the president and CEO, Randy Reichert. Now, we're following up on a big news release for the company, the definitive feasibility study for Eskay Creek that was released on November 14th. Now, one note here is that the company did conduct a conference call, and a replay is going to be available at the link below this interview. So what I'm going to get Randy to do here is walk through some of the key slides and some of the slides that I've received some questions on the back of that feasibility study. So Randy, thank you for taking time to isolate some of these slides and walk us through this definitive feasibility. Let's start with the overall numbers here, including some of the sensitivities. The overall headline being after-tax NPV of $2 billion Canadian, a 43% IRR, and a 1.2-year payback. You've also outlined some of the sensitivities here at a lower price of gold and silver, and at some of the higher prices, including the spot price at the end of November. Randy, walk us through some of these key numbers, please.
Sure. Thanks for having me, Corey. So as you mentioned, our base case gives us a $2 billion after-tax NPV, which we're extremely pleased about. Continuing on to have an excellent IRR for the project and a very quick payback. One of the other metrics we should really highlight today, all-in sustaining cost is $684 an ounce. That really puts us in, the lowest realms of operators today. It makes it a tier 1 project without question. And of course, what's driving that? The driving that is the grade. Still phenomenal grade, 3.6 grams per ton overall. I'll get into it in a minute about really the first years are much higher than that. We've also extended the mine life to 12 years from 9. So that's where we're sitting. Now, the CapEx has had an increase. That's kind of on the back of we've added some extra stuff, and there's been certainly some inflation as well. Where does that put us today? It really puts us today at spot prices where we're at right now, 2.3 billion NPV and a 47% after-tax IRR. So kind of metrics that are incredible at this point. Look, let's say gold's going to go up to 2,200. Certainly not a fantasy these days, seeing what's going on in the world. That would give us 2.8 billion NPV for this project. But as well, as you say in the sensitivities, at the lower end, it's also incredibly economic. And this drops well below. So if we just look at $1,600 an ounce gold and 21 silver, so quite a bit below where we're at today, we still have a 1.6 billion NPV, 37% IRR. So the metrics on the project are good. It's robust, even quite a bit below $1,600 gold.
Now, just a quick comment on that CapEx. We all see in the bottom right there, CapEx is $713 million Canadian. There's also an increase in the sustaining capital, something we've seen a lot of companies do, but the sustaining capital being $561 million. Can you take us through some of the key changes there on how you're allocating the capital costs here?
Yeah, sure. So we need to look at the sustaining costs right along with operating costs for the mine. So the majority of the increase for the sustaining capital in the DFS was from a change in how that's accounted for. So in the previous feasibility study, most of those costs were included in mine operating cost per ton. What we did is on this study, what's normally done through the life of a project, and your waste is capitalized as you start new phases. So that's what we've done here. And by doing that, we've moved about $385 million, which was previously really under the OPEX cost, into sustaining capital. So that's the big change. And what we see is a drop from like $370 operating cost per ton down to $3. But then again, it's just really a transfer of some of that into sustaining capital.
All right, let's move on and talk about the production profile. It's one thing I've talked with your team a lot about is how you've been looking at adding mine life on the back end. But as we can see, the production ramps up right away. A lot of production in years 1 through 5. Take us through this life of mine production profile, please.
Yeah, so let's start with the gold line at the top and on the left. That's the grade. We can see that we're averaging well over 5 grams. The first 5 years is an average of 5.5 grams gold equivalent. You know, kind of unheard metrics for an open pit. That's what's really driving the production. That's really what drives the cost. We look at the production first 5 years, 455,000 gold equivalent ounces average over that. There's one of the year touching on 500,000 and a couple getting very close. So the front end of this is definitely, robust and high. The back end, it starts to tail off. We've done that on purpose. So when we've looked at this project, we've brought, more of the grade to the front end of it. The back end of it, we believe we can fill in more with the production, the years 6 to 12, through projects like SNIP. So SNIP, we're doing an economic study on that right now, but we think that bringing it in, hauling it here, we have the potential for really bulking up those later years.
Okay, so the focus still being on bulking up those later years, but maybe with the incorporation of SNIP, less so just on discovery and exploration at Eskay then.
That's true. We have this project. It looks like a great project, and it looks like a perfect project to tie right into this. It's about 45 kilometers away. So it's close for a high-grade feed to bring it into Eskay. That said, we still are focusing on doing a lot of exploration, and we believe that there's still room to grow this and fill that in from exploration as well.
Now, is it important to understand, too, that if you can bring in more cash early on here, that helps to satisfy all those sustaining costs?
Yeah, absolutely. The quicker you can pay it off and get it in, higher NPV, and the quicker the lenders like it as well, right?
All right, let's move on to some of the concentrate comparisons here from the feasibility to the definitive feasibility. Talk to us about what changes were made here, please.
Sure. So this is kind of one of the biggest drivers overall, probably the single biggest driver of NPV. We went kind of back to square one, looking at some metallurgical testing, and kind of went back to basics. By just tweaking those met tests a bit, putting more reagent up front, we were able to produce a more efficient flotation process and created a concentrate that was about 74% higher grade on average. So if we look at the graph here and we see the two lines again, the gold line and the gray line. The gold line represents the grade of the concentrate now in the DFS versus the gray line, which was in the feasibility study. So a big jump up in concentrate grades. What does that do? Well, when you look at the bars then show the number of tons of concentrate you're selling or shipping and producing. So the gold bars quite a bit lower and smaller than the gray bars. And what that means is we've got, compared to what we would have had if we used the same parameters from the feasibility study, about 1.1 to 1.2 million tons of concentrate less. So if you think about shipping all this concentrate to, say, China, there's the transportation cost to get it there, plus the smelter charges. Smelters have to bring, and process this as well. And so they charge you for that. So those kind of two reductions in costs save us close to 400 million pre-tax over the life of the mine. But as well, that difference in the lines, and I'll get back to the lines, the higher grade concentrate you are means that the recoveries at the smelter are better and the higher payabilities that they give you. So essentially what we're getting out of this is a lot more value for what we're sending.
That's interesting. Now, are there any more changes that could be made here to further refine this, bring up the overall value of what concentrate you are producing?
Um, the next step on this would really be to optimize the mine plan. So really bringing in different feeds into the plant to produce concentrates that will go to particular smelters. And so by optimizing that, we're kind of optimizing the payability that we get out of, say, 2 or 3 different types of concentrate. And so that would be the final step.
Okay, let's move on to the NPV changes then, because now the
Sure.
NPV again at $2 billion Canadian at the base case. What were some of the big changes that we should note from that feasibility study?
Yeah, so they really came from 2 or 3 areas. The first being the reserve grade at mine life, right? So we extended that by 3 years. How did we do that? Well, we had 14 months of drilling, and so we used that. We incorporated that. Along with that, we did some remodeling. So the plan is to mine this a little bit more selectively than what we were planning in the feasibility study. And by doing that, we could use a smaller block size, basically reduce some dilution, and that increases your grade. So that also had a positive impact. So the reserves increased from 3.8 million ounces equivalent to 4.6, and the mine life increased by 3 years. On top of that, just what I'd been speaking about before, the reduction in the mass pull in the flotation circuit, saving us at least 1.1 million tons of concentrate and giving us some really good savings over the life of the mine.
So you
Those are the
mentioned
key drivers.
you mentioned
And
that
of
you're
course,
going to be mining more selectively. Does this add complexity to the mining because you are being more selective?
it's typically what is being done in most of the high grade open pit gold mines in the world today. Shovels has been replaced by backhoe excavators, and so you can take a 10-meter bench, blast that, and essentially divide it by into 3. And by doing that, you get more selectivity, almost the exact same productivity.
Do you need to do any more drilling to further de-risk the overall asset then, what you know about the deposit?
No, I mean, it's a good point. When we look at the reserves, and if somebody looked at a reserve table, uh, you've got the proven and probable categories. 80% of our gold equivalent ounces are in the proven category. I don't think I've been involved with an open pit that started with any proven. Maybe a few percent at most, and most of it all being in the probable category. So we do have a very high confidence in our reserve. And of course, as we go to mine it, we'll do what is called grade control drilling, and that gives us a lot better detail as we're about to mine it.
So looking down the road, what if the gold price gets a lot higher? Would you maybe mine less selectively?
Typically, what we would do is you just segregate your grades. So we would bulk up and we would stockpile more lower grade and keep the feed going to the plant. Again, if you sent a whole bunch of low grade early on to the plant, what you're going to do is produce less ounces. So you're going to pay back, even though gold price is higher, is going to be later. So that's typically what operations do, is they segregate into high grade, medium grade, and low grade. And so we just bulk up that low grade that would come out naturally.
Okay, perfect. Thank you, Randy. Look, if anybody has any follow-up questions, as always, please email me. I'm happy to dive more into any of this feasibility or definitive feasibility results for you in future interviews. Let's talk about some de-risking aspects next then. What does the company need to do to continue to move this asset forward, and who knows, potentially get into a construction scenario?
Yeah, certainly. So of course, by doing some de-risking stuff, and really, Corey, I should say, this study is done in order to build it. So the engineering and what we're doing, and when we're looking at the operations, what it's going to look like, this study has incorporated those. This isn't a study that's been done, to make it look really, really good in order to sell it. This is a real study. I think any company could come along and go, yeah, we can build it that way. So some of the things we've done that have increased a little bit, we're putting in a water treatment plant. That just makes sure we're always in environmental compliance. The permanent camp, we're basically bringing in and we're installing that a little bit earlier than we're going to do for the feasibility study. All right. And then, some of the other cost drivers we had, camp operations, travel costs, those have gone up. Okay. The other things we're doing to really de-risk. So we're increasing the ore stockpile size. So the area where we put these stockpiles, basically, if we can segregate different types of ore, we can blend it in better to the mill. As I was explaining to you just before, that allows us to produce different types of concentrates to maximize smelter payabilities. We've also increased the mining fleet. That's to provide, a higher amount of production in the months where we're not getting, heavy snowfall. We've also increased the amount of mining that we're doing ahead of pre-production. We've made flatter benches. That makes snow management, again, easier. This is as well to build up the inventory ahead of production startup. If you've got an inventory of ore sitting on the ground waiting to be fed into the mill, it decouples any of the problems that you're having in the mine from the processing. Okay, and then a couple other things, just putting in a more robust building, for instance, to withstand the snow loads.
Yeah, it sounds like these very much are the move into more construction with permanent camp and understanding all the costs that would go into that. You mentioned snow a couple times in there. I have had a couple questions on how the company might deal with snow over those winter months. Can you address that for us?
Yeah, it's a question we get sometimes. So if you look at this slide here, and you can see the orange is really the first main phase of the pit and where that first ore is coming from before startup. And what we've done is we've redesigned it. So if you looked at the feasibility study, you would have seen kind of over towards the top right portion of that orange was a bowl that was created. The problem with bowls is when you get in snow, you've got, ability for the snow to collect in it. It's harder to get rid of it. And as well, you've got a bunch of equipment working together. So we've flattened off the benches to daylight on the hill. That makes snow removal a lot easier. And we've opened up the area, just making, the equipment work a lot more efficiently and less congestion. So that's one of the big things we've done. The other thing is by bulking up the mine fleet. So on average, we probably need to mine here about 100,000 tons per day ore and waste. We'll do in the summer, we'll increase that to 150 or so thousand tons a day, allow us to stockpile more ore over that period. And then in the winter months where we are, the days that we're getting heavy snowfall, we're dealing with snow instead of ore, we'll be able to drop to an average of 50 to 70,000 tons a day. And so it's really just that cycling and stockpiling ore so that the mill can run constant throughout the year.
Okay, thanks, Randy. Let's look ahead. What does the company do next? A lot of people are wondering, are you going to build this? So what still needs to happen before you make that decision?
Yeah, well, certainly, yeah. Our intention is to build it, and we are moving ahead with a number of things to bring it into construction. We've got lots of plans of work to do for next summer. Certainly, one of the things we want to look at is some steepening of the slope. So if there's a next driver that would be able to increase NPV, it'd probably be this one. If you look at the slope, and I've got a graphic up there right now showing the north wall. So on the left side, that's the north wall. It's really shallow slope, and we think we can steepen that. If we can steepen it, we can get some of the ore. You see the gold material continues deeper. So by looking at dewatering the slope, basically taking the water pressure off the slope, we think we can steepen that wall and increase that. So that's one of the next things we want to do. And of course, we want to continue doing a lot of exploration. We want to do some continued trade-off studies between maybe we can mine some of this material from an underground method and not drive the pit so deep. And the big one is SNP. So our SNP project is mentioning, that's what we really think now will be the next big one to bring in and increase the overall number of ounces that Eskay will produce.
So I guess outside of bringing SNP in there, that could be a pretty big change to especially the back end economics. Any of these changes or ongoing work, are any of these major in terms of truly changing the overall strategy here?
No, not in terms of the strategy. The strategy has always been, okay, we've got the bulk of the tons and the ounces in the front end. So then it's a matter of, what do we do to grow the life? We've done that some. And now it's a matter of filling in that ounce profile so that, making sure our all-in sustaining cost over those last years remains, fairly low. And so that's bringing in the other stuff through, whether it's exploration or whether it's from SNP or other sources. That's really what the strategy is.
So, Randy, I do have to ask, final point on this slide, project financing package announcement coming soon. I don't want to get you in trouble by telling us anything you can't, but what can you tell us about what you're weighing in terms of financing packages?
Sure. So, and Walter alluded on this on our call earlier today. What we can say is now that we've got the DFS out, we can, really get into discussions with some of the potential lenders in earnest. So we've had a lot of initial discussions with them, but now we've got, a plan that we know we can execute on. So it's really about getting into those discussions with them now. Our intention is to focus primarily on non-equity in order to build this. Things like stream. When we really look at, where our share price is today compared to the value of the project, our price to NAV is probably 0.2 today, whereas we think, we should expect something more along the lines of 1.0 with a stream. So we think the cost of capital is probably lower on that. So that's what we're really intending to do.
All right, Randy, thank you very much for walking us through some of the highlights of that definitive feasibility study. As I mentioned, everybody listening and watching, please email me with any questions you have for Randy and the team over at Skeena. Happy to get those addressed for you in future interviews. My email address is fleck@kereport.com. And again, I will be posting that replay of the conference call so you all can go through all of those slides that were presented. These were simply some of the highlights, I think, from that definitive feasibility study and from some of the questions I've received. So, Randy, thank you very much for your time today.
Thanks for having me, Corey.